Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Frederick, managing director of trading and derivatives for the Schwab Center of Financial Research. And Randy, it seems as if the question of the day is, with stocks surging on this Tuesday, is it a periodic rebound, or is there more volatility expected driven by Fed policy and what's happening with rates?
Well, I'd say it's a little bit of both. One thing that is pretty interesting is that this is the fifth consecutive quarter where we've seen a substantial change in the direction of the equity markets on the very first day of the quarter. Go back to October of 21, January of 21, April 21, July 22, and October of 22 now. In each of those instances, we've seen a really major shift. It wasn't always from being in a downtrend to an uptrend, but there was a substantial shift in equity markets. Prior to that, for like 3 or 4 quarters, not a whole lot happened. So from that sense, yes, it's the same. But Fed policy is obviously the biggest piece of all of this. We know we've had 3 full percentage point raises in the last 6 months, which is huge. And markets are volatile as a result of that. I think the concern we have right now is what's going to happen next. We do know we have a meeting on November the 2nd, and there's about a 75% probability of another 3/4 point hike. Personally, I would love to see them pull back and hike only maybe a 0.5 point. I think a quarter would actually be ideal, but I think the best we could hope for is about half. We just don't know. I think we're going to have to wait on that.
You know, it's interesting. This week, every institutional investor surveyed by Evercore ISI expects the U.S. will fall into a recession. Every single one of them. Does that suggest a recessionary outlook is already reflected at current prices?
I think it's definitely reflected in it for some people. What I would say is this. Here's what my concern is. My concern is, just like the Fed was way behind the 8 ball on the beginning of the hiking cycle, they were stubborn and told us for at least an entire year that this inflation was transitory, despite every market analyst and every economist out there saying that we need to get ahead of this. Then they started hiking, and now they're in this massive sort of bulldozer mode where they're just going to keep hiking and keep hiking and keep hiking to get inflation back down to 2%, which I think is frankly a pipe dream at this moment. I think maybe something more like 3%, 3.5% would be a more realistic thing. But here's what my concern is. Because they're not giving the economy and the markets enough time to react to their policy changes, they're going to overshoot by overhiking. What happens then is you might create financial instability. You might crush foreign markets. We've seen some real challenges already in the UK. We've seen we've seen other countries say, hey, look, we need the US to sort of pull back. The United Nations, for example, said, hey, we need the US to pull back on these rate hikes because you're crushing everybody else. And what ends up happening is they overshoot, at which point they stop hiking or really quickly next year. Markets will rally like crazy. And then all of a sudden we have inflation again. And next thing you know, they start hiking rates again. That's when I think we might potentially run into a recession. And that's why I think it would be smarter for them to pull back now and ease off, maybe go just a couple of meetings without a change. But I think maybe that's the consensus perspective, is that the Fed blew it on the way up. They're going to now blow it on the other direction. And we could very well end up in a recession. I don't think that's going to happen this year, but I think there is a reasonable possibility next year. Right at the moment, we got over a 2% estimate for Q3 GDP. We did have 2 negative quarters. They were very moderately negative. But right now, the outlook for this quarter is that it's actually going to be positive.
You know, it's a great point that you bring up, Randy, because I think sometimes we forget that the market and economy are 2 very separate things, and the market tends to react much quicker than the economy does, and that these interest rate policies are going to take time to play out. So that is something I think investors should be mindful of. But let's take a look at some technical levels, because at the end of the day, it's the price action that's going to confirm what the market is thinking. What levels are you looking at as it relates to the Nasdaq 100?
Well, there are 3 key levels that I think are important to watch. The first one is the level at which the Nasdaq goes into a bull market again. That's not until we get to about 13,165. So that's 20% off the bottom, which frankly was just hit last week. That's the other important level, 10,971. That's where the downside support is, and it's a pretty solid level of support because we did take out the June lows. But there should be pretty strong level there. But what concerns me is if we happen to break below that, and I don't expect that, I will say that, then we may not see some stopping point till we get down to about the 97.18 level. That is the pre-COVID bull market high before we went into that last bear market. And again, that's 1,000 points down below where we're at right now. So what I would be paying most attention to is just to be sure that we don't take out that low that we set last week.
And finally, Randy, anything that you're seeing, whether it's VOLQ or VIX in the volatility space, that could suggest near or short-term volatility?
This is fascinating. This is one of the only, in fact, this is the only bear market, really, where we haven't seen a capitulation level of volatility spike. I mean, it's just volatility, surprisingly, despite having been in 20 for the couple of months and then going into the 30s, has been relatively calm. And we haven't seen that real panic level. We've seen high anxiety, we've seen high uncertainty. We have not seen panic yet. And I don't think that means we have to see that, but it would be unique in that perspective. For as long as we've had volatility gauges out there, this has been the one bear market where we have not seen that level of panic. I don't know that we will. If we do, I don't know that it's going to happen this calendar year. I think once we get past the next Fed meeting in early November and just 1 week after that, the midterm elections, then I think we could have a pretty solid year-end finish.
All right. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.